Welcome back, everyone. Today's video is about a stock that I seem to like talking about almost as much as it dislikes going up. Linamar. So there's a lot of stuff in this. Hopefully one or two of you enjoy. As always, this isn't investment advice, and of note, I have been long this stock for a while, and if measured by performance, I've also been wrong. Now, whenever anything seems to happen in these markets, the first point of discussion is around tariffs. And Linamar is no different. Everyone seems to, what's the tariff impact going to be? And that's a two-part question, because if we're talking about the tariffs that are so far, then it seems to be pretty minimal because USMCA compliant goods are exempt. Could that change? Maybe. Could an asteroid hit the Earth? Definitely. Could we choose to have an asteroid hit the Earth? Possibly. This is the world we're living in right now. But as of right now, the tariffs could hit the economy, could hit automakers, but are not directly impacting Linamar. So now I want to quickly run through the segments of Linamar. And the first and the biggest is mobility, auto parts. Many people think of Linamar as an auto parts company because for a long time it was, and it exclusively was. And then they added various components, but to this day, the mobility segment by sales remains by far the biggest. It has about $7.5 billion in sales, and while the normal operating margins are 8.5% plus or minus 1.5%, currently the margins have still remained below the normal. And there have been an endless slew of reasons for why that has been over the last few years. It's improving, but it's still below normal. Recently, the continued distress in autos and the market turmoil has led to some opportunities where they've been winning takeover works, and they've also made acquisitions in the past of distressed assets and done pretty well with that. That said, at the moment, like their other divisions, they have open capacity in mobility. And realistically, the mobility segment, while I'll get to later why it used to seem like it was a fairly decent business, recently it has been a rough few years since COVID, and there's an endless, seemingly, list of reasons why the market has decided it does not like autos, it does not like auto parts, and it never will again. And just some of the endless reasons why that is, aside from, of course, autos being a no growth and low margin industry, recently have been the supply chain shortage, chip shortage, inflation, the EV adoption, which it stops and starts, going backwards, forwards, multiple strikes. Oh, and now tariffs. So obviously this is a business that everyone can't wait to dump all their capital into. And I wasn't really joking when I said it's a no-growth business. We have actually barely just recovered to pre-COVID levels of volumes in auto sales in North America, or the US, I should say. We briefly got there post-COVID, and then in 2021, right before we had the chip shortage, supply chain shortage, everything broke, and all the inflation. And then only recently, on perhaps tariff fear pull forward, we got to the levels where we were at before, but it's been multiple years. Oh, I forgot to talk about the interest rates before. Yeah, interest rates making autos less affordable. And so yeah, the industry on balance doesn't really grow that much, if at all. That said, autos aren't necessarily auto parts because within the car there are many parts, and the companies that make them can make more of them or make more different ones or roll up other companies. So over the last, well, since pre-COVID, and I'll get to in a second some examples of even more years, Linamar has been growing about 6% their content per vehicle. So even with a flat number of cars, they've been growing. Now, that hasn't been a ton, but this has been in a time where a lot of their capital has been deployed elsewhere, which I'll get to next. But before that, this is a chart from back in 2018, which shows data from 2013 to 2018, so pre-COVID, of their content per vehicle in each region. And I think it's interesting, we're now 2025. If you look at 2015, so 10 years ago, and you compare the numbers to now, so in North America, 150, Europe, 40, Asia, $6.70, less exposed to Asia. We're going to look, but remember this, because they are just about double in every region. And this is what it looks like today in 2025. You can see North America, $300 per vehicle, Europe, just under 100, and Asia, 1175, so just under double with Asia, slightly more than double Europe, and roughly double in North America. So this amounts to about a 7% compounded over the last decade. Now, you could easily say, well, that's not that good. And I agree. It's not spectacular. But, and I'll get to this in a second, this is over a period where the whole industry has, faced all sorts of problems, margin problems, and B, Linamar hasn't really been focusing their capital deployment on this industry. So where have they been deploying capital? Now, agriculture. Linamar's agricultural division now consists of 4 main brands, all of which were acquired over time, Oros being long ago. But in 2017, 2018, Linamar went out on a venture and they put $1.2 billion into MacDon. A few years later, in 2021 or 2, I think it's 2022, they bought Salford for, I think it was 240 million or something like that. And then about a year ago, they bought Bourgault for another 600 and something million. So within the span of 5 or 6 years, they put $2 billion into an array of brands and built a very impressive full crop cycle, short line agricultural equipment sector business. And I put a note on the slide that when they bought Bourgault, they were talking about synergies and expanding to international growth and cross-selling. And it's really interesting because if you look back to what the company was a decade ago, when everything was going well in autos, if someone said, oh yeah, there's going to be synergies in ag, you'd look at them like, what ag? And I'll get to why this is more relevant in the future, but the point is, over the last few years, they've built this agricultural division that does maybe 1.5 to 2 billion in sales, depending on where you are in the cycle and what assumptions you want to use. And that's at 14 to 18% EBIT margins. So, depending on how you want to look at it, up to 300 million per year in operating earnings. Not bad. It's about a 15% yield on what they paid. But now, with the full crop cycle covered in ag, and they have multiple leading brands, this division looks like one with minor tuck-ins possible, but mainly a nice source of free cash flow and decent margins, and hopefully a high quality division that they can take globally. Last, and unfortunately least, is the aerial work platform division, Skyjack. Now this has a bit of a fun story behind it. Skyjack, that you've probably seen around and might not have thought much about, was a struggling industrial company that made aerial work platforms back in 2001, 2002. Linamar bought it in two pieces, and they paid about $33 million for the equity. There was another 10 million-ish, 10 or 11 million in loan that was somewhere in there. And today, Skyjack does 1 to 1.5, maybe call it 1.33 billion in revenue, depending on the year, with a 14 to 18% EBIT margin. So that's in the range of 200 up to 200 million per year in EBIT. So assuming a reasonable multiple, excluding all of the potential dividends and potential acquisitions that were made with the profit, that would be a roughly 50 bagger. Not bad. And Skyjack now has a global footprint and capacity to grow unit sales quite significantly, actually. So for context, sales were north of $1 billion prior to the expansion, and a few years ago they had a very large expansion globally and added a bunch of new factories and are in market for the market, all as they call it, globally, and they've roughly tripled their unit capacity and now have a global reach. So $1 billion in sales before. I do not think that they will max out this capacity anytime soon. I want to be very clear on that. But I'm just saying they have the ability, and the capital has been put in place for them to have the ability to make the growth from here something closer to organic and not require organic and capital light, I should say. Next, I want to talk a little bit about valuation. Now, when talking about valuation, I think the first thing we have to decide on is which one we're going to use. And this is basically three cyclical businesses slapped on top of each other. One is very capital heavy, the other are much less capital heavy. So how are we going to look at this? And I really think that the only good way to look at this is a bad way to look at this. If you look at, you can't really use price to free cash flow, because I'll get to this in a second, but free cash flow is all over the place. You can use price to normalized earnings. That might work. Price to book, I know that's like the most useless metric in the world, but it's also might be something to look at. And we could also maybe look at price to free cash flow excluding growth capital. So basically sustaining capital price, what would the free cash flow be if they're like, okay, we're just sustaining our business, no growth, this is what we got. So I saw a discussion at one point where people were talking about what is the right price to earnings multiple for Linamar. And I found it very interesting because, as you can see in this chart, this is the 1990s through 2016. And just eyeballing it here, but it looks like it traded most of the time between 10 and 15 times earnings. And by the way, this is when it was mostly an auto parts company. So there was less of the arguably higher quality or businesses that now people seem to think are decent. This is when it was mostly an auto parts company, 10 to 15 times earnings. But then something weird happened in 2016. Since 2016, it has traded regularly at a much lower multiple. Now, there has been a lot of stuff that's happened since. Mainly, there was an industrial recession in 2019 and the GM strike. There was COVID in 2020, obviously. And then since 2020, there's been a whole lot of disruption. But, you know, people were looking at, oh, is 10 to 15 times earnings, is that a high range or is that a normal range? And I would think it should more so be a normal range, except recently it hasn't been. So recently also, when they've had the, since in this chart here is where they've had the agricultural business, and they put together that higher quality business, and now industrials make up a bigger proportion of the sales, and they've had a lower multiple. So go figure. I don't really know what to make of it, aside from that the market is discounting something more. But maybe a sum of the parts might be a better way to look at it. Now that we're discussing the multiple different business lines, what are each of them worth, and then maybe some discount, because apparently, some of the parts never seems to work. I'm not even complaining about that. I'm just saying it doesn't work. The industrial business, if we look at 3.1 billion in sales for the industrial, normal EBIT margin, that's about just under 500 million in EBIT. If we look at access, some of the peers were trading around 8x, and ag, you had all the way from about 8x to 20x to more, if you look at, depending on what comparables you want to do. I'm not going to put the ag at 20x, even though, it has been growing and outperforming the market by a wide margin. If we gave the industrials 8x, that's 4 billion in value. And similarly, if we look at the mobility, the multiple hasn't been that much more depressed. You look at a number of the bigger peers, they trade between 6.5 and 8 times EBIT. And if we look at what the normal EBIT would be, it's almost 640 million. Now, that's just assuming they get the margin back to the middle, and then subtract the debt, that would be about 123 per share. And the key bit here is that if we add these up, the EBIT, I should say, that's almost $1 billion a year to invest, whether that's in acquisitions or in capital expenditures. But just looking at round numbers here, using that EBIT that we just came to, 6 times earnings before interest and taxes would be about $100 a share. I don't know if that's the right valuation, but it's a round number that just kind of fit right in. So I'm like, hey, I'll just throw it up on a slide. Why not? Now, excluding the recent quarter, despite the share price seeming to never go up in any circumstance, the invested capital and the book value per share of the company has been consistently going up. And even through the struggles, even through all of the disruption, if you look at the last 10 years, it has just about tripled the value of the company, except not the stock price. But anyway, it's now at 90-40, I think, after the most recent quarter. And it's continued going up, and in a few quarters will probably hopefully hit $100 and be at a price higher than the stock has ever traded, which, albeit, doesn't seem to matter because the valuation just keeps going down, even on a cyclically adjusted basis. I mean, if you look at past cycle peaks in the 90s, went up to 6 times book. Back then the margins were crazy, so don't even look at that basically. But if you look at the 20 teens, early 20 teens, I should say, it peaked around 3 times book, which means that over the last decade, the multiple went from 3 times book to something closer to half of book. So that is a lot of multiple compression. And that's as the book value keeps going up. So, what I've said a number of times about like what would make the stock work, I'm like, well, if it stops getting cheaper, it would probably work, but it doesn't seem to want to do that. But look, book value is not a very good metric because retained capital could be well spent or not well spent, and things could be vastly overstated in book or understated, and that's always the argument that you'd come to. So I'm just going to put a few of the things up here and make a few comments on what is in the book value, that is. So they have $1.5 billion worth of buildings, and some of which are newer, but some of which are older. But again, the buried real estate play is another one of those theses that just doesn't work, like, ever. But I would say that there's likely to be some value in real estate, particularly old real estate held at cost. So 1.4 billion, the book value, and that is just under $1 billion because of depreciation or amortization. And so there's probably, I would argue there's probably some value there if they monetize the real estate, but who knows? And that's not the thesis, because I also like owning real estate beneath the building. It gives you, beneath the business, it gives you some support, I find. The other thing I want to point at is Skyjack. Skyjack, the intangibles, goodwill on Skyjack is just under $13 million. And, the brand here does more than $1 billion in annualized sales. So at this point, it's basically carried at the asset value. The $13 million doesn't move the needle. And so, you get no value in the book for the brand. So, I would argue you could make a case that maybe the intangibles on something like Bourgault or MacDon might be too high. Maybe some of the Linamar structures, that could be too high. But, I would offset that by saying, well, I think Skyjack is way too low when you're looking at book value. And as I mentioned before, free cash flow is just all over the place because they can cut the investment to minimal sustaining capital and the free cash flow just goes way, way up. But that's not necessarily better than when they see stuff that they want to invest for growth and the free cash flow goes to zero. So you can't really look at free cash flow for this, and that's my opinion. I've said in the past and explained it poorly other times too, but I think they could do a lot of free cash flow if that was their goal, but their goal is growth. Now, as I get into a few points on capital allocation, one of the things I want to say is yes, I agree. A buyback would be very accretive at these prices. But I do want to say that I believe that it's probably a limited option because the float is starting to get limited in terms of what they can access. You look, there's 60 million shares, 20 plus are owned by insiders. So you're really getting to the point where there's maybe 38 million shares on the float, and 10% of that is the NCIB, so that's 3.8 million shares per year. And you're probably not going to get substantial issue bids. And this is why I think they're really trying to reiterate over and over again that they want to focus on growth, because chewing up the smaller and smaller float, diminishing returns, basically, I think. And so they have done some very good M&A that I'll get to. So if we're looking at the company as something that has basically $1 billion a year to deploy, that's $1 billion, by the way, plus maybe 450 million to get back to the bottom of where their leverage target was, because they're actually at about 0.8 times net debt to EBITDA when you adjust out for the one-time loss in Q4 on the write-down, and their target is 1 to 1.5 times. So $1 billion plus 450 million, so 1.5 billion. And out of context, I mentioned before, but this is like the prices they paid to set up this ag division. That's, MacDon was 1.2 billion, Bourgault was 0.6 billion, Salford was $250 million. So when I'm talking about 1 billion, 1.5 billion, we're talking about like MacDon plus Salford, and then another 9 months later, Bourgault. And I'm just saying that this division now earns 300 million a year in EBIT, and I should note, has basically paid for itself. Like if you look at the EBIT from the time they bought MacDon through present, it's basically paid itself off, and the MacDon has then funded the rest. So, that's a decent capital allocation when you cut it out and put it isolate it in terms of what that acquisition has done. Plus, I could point out that this whole agricultural division has basically been funded by Skyjack, if you include the debt capacity. And the Skyjack, when you rewind way back, was bought for 33 million. So the industrial division, that venture out of the auto business, has been very, very effective. Now, while there have been some poor ventures into the auto expansion as well, I would be remiss not to mention that just a few years ago, they acquired some assets from Mobex 4th and 1. And what they bought, they got $450 million in sales, and they paid about 90 million Canadian for that. And if you normalize what the EBIT would be from that segment, they paid about 3 times EBIT, not EBITDA, EBIT. And if you're thinking, okay, well, that now supports 1.5 times EBITDA in debt capacity, I mean, they paid very little for that. And I mean, that's got to be a good deal. And I would have no issue whatsoever, and I don't think many other people, even people who dislike autos justifiably for like 100 different reasons, I don't think those people would have much issue with them replicating that acquisition. But despite the languishing share price, one of the things you'd probably never notice if you didn't look at it is that their EBITDA is basically at an all-time high and probably going higher next year because of the margin expansion. because year after year, I mean, there's certainly been some significant issues, but when times are okay, this has been a rather decent company. And this is just to further kind of illustrate the point in very loose terms. They were able to string together many years in a row of growing the core business by about 20% per year. And this is what I think the company, I think they could at least do high teens if the market would for once just not be terrible. And I think obviously they're susceptible to big swings when there's disasters, but if the market can just not suck, I think the company is actually pretty good. And from where they are now, with a lot of balance sheet capacity and a lot of opportunity in the market, there's potential. Because looking at it from the capital allocation standpoint, $1 billion a year, by 2030, that's $5 billion that they could deploy into growth or M&A. And that's like $80 a share. So while everyone's talking about how much autos suck and tariffs and all that jazz, what we really should be talking about is what is going to be the other half of the company. To which I would say there are some hints out there as to where the company could expand. And, I want to rewind to before where I mentioned just a few years ago there was no ag division, and then just last year the company was talking about how they were going to cross-sell the Bourgault acquisition with MacDon and generate synergies and scale from that. And I think that we could see a situation in a few years where the same thing happens with the medtech division. Now you might be asking, what medtech division? Exactly. But look, even if they don't go out in a completely new direction, which I think there's a lot of evidence that suggests that they could pull it off if they did. But if they didn't, their main options would be mobility or more industrial growth. And they're two different paths, and I think they could make either work. But the mobility, you probably, especially now, are paying much lower valuation and can probably churn out some good returns on very cheap assets. That being said, the mobility business is highly capital churn, and that is not necessarily what a lot of people want, of companies needing to keep deploying capital to keep growing and to keep the business up. Now, that being said, it is a huge market, and they do have a lot of expertise in it and have made some very good acquisitions over time. On the other hand, the industrial business, higher margin, higher quality, less capital, and it can spread out the cyclicality of the business that would give a more steady earning stream and the ability to act counter-cyclically in more environments when they're able to grow. Like now is the perfect example where autos suck and they have this cash flow from ag and Skyjack that they could say, hey, we have a few $100 million in cash flow. We're going to just keep buying all these distressed auto assets. Or versus, if you look at what they did a few years ago when autos wasn't, they didn't really see much to invest in autos, and they just went out and bought MacDon. So when I look at the business and I look at, where can it go in a few years, there's two scenarios. One of them is if you look at a company, uh, for business lines, whether that's mobility, ag, access, and medtech, or maybe the industrial stays as a division and they have medtech and water or whatever. Each of these divisions maybe has 750 million in EBIT. After a few years, obviously, they need to grow into them and acquire them. This isn't like a 1 or 2 year thing. But you just look at a business that's pretty balanced, has 3 billion in capital to deploy each year, and you can kind of think of what that might, a diversified roll-up story with a reasonable valuation, if they can, because they have been decent operators in all the businesses all the business lines that they have. So, you could look at what would that type of growing company be worth. And the other alternative, and I'm not even saying this is bad, is that they just see all the distress, see all the cheap auto assets, and they just keep rolling up the assets at, 2, 3, 4 times EBITDA. And, if the assets add 1 to 1.5 times EBITDA and balance sheet capacity, you could kind of do the math there on how much that could add per year. And you're looking at it like they say they deployed a lot of capital into that, could add 500 million in EBITDA per year, or grow EBIT maybe 20%. I'm just throwing out round numbers here. There is some math behind it, but I'm not saying it's perfect math, but that's growth. But to summarize the story, I think Linamar has been a surprisingly good capital allocator given the difficult sector they're in. I think there's more diversification and quality than what a lot of looking at the stock might suggest. And I also think there's multiple existing and possible new outlets and verticals for them to grow into. And I think all of this, plus a starting valuation that seems pretty interesting, makes Linamar something that is worthy of further analysis. And that's just about all I have for today. Thank you so much for watching. I commend anyone and everyone that made it through my hours of yammering. I appreciate you. Thank you and have a great day.